You want it? We have it. The hottest mortgage and real estate strategy broadcast in the nation. A Smarter Way Home with your host, Danielle Boote and Victor Bals. 50 years combined experience, ranked in the top 1% in the nation for home loan originations 2020. Promise to expand your knowledge, utilizing creative mortgage financing and home buying strategies. Build a bridge for a better quality of life. Get your brain cells firing for a smarter way home. And good morning, everybody. Welcome to A Smarter Way Home. My name is Victor Bals, and I am here with my co-host extraordinaire, Mrs. Danielle Boote. How are we today?
Good morning, Victor. I'm doing great. How are you?
Good. I'm getting fielded a lot of calls that the real estate market is going to shift. Oh, it's going to crash. We're into a bubble. Are you fielding any of those phone calls as well?
Absolutely. I do have buyers that'll call and say, I'm going to wait until the market changes.
Yeah, I'm going to wait for prices to drop. Mm-hmm. I'm going to wait till the economy gets better. You know, we're hearing a lot of this stuff here. So today we want to discuss some of the items that, is there a bubble coming? Personally, I don't see a bubble coming. What are your personal thoughts?
I would agree with you there. I do not see a bubble coming, and there's definitely, if you were to compare this to the pre-2008 market, there's a lot of differences.
And let's go through some of those differences. Let's get your view on this. Why is there not a housing bubble coming again?
Well, if you let's look at current lending standards. A lot has changed in the last 10 or 12 years, post-2008 and that crash. Prior to 2008, let's do a little bit of a history lesson here. Lending really got loose.
And how loose did it get? Give me an example.
Some of the loan programs that were very popular in the early 2000s. Now, some of this is going to be regional. I'm going to speak more on a nationwide basis because we didn't see as much of this into the Detroit market as the rest of the country did. But I want to kind of paint a really broad picture here. We had many interest-only mortgages. An interest-only mortgage was a loan that never paid principal. We had a lot of adjustable rate mortgages, meaning interest rates could go up or down.
And those are your ARM loans.
And there was a lot of what we would call non-agency ARM loans. Okay, so we still have adjustable rate mortgages, and they can be a good financial tool for a homeowner, but they're not real popular because rates have been so low. Back in the early 2000s, the ARMs were very popular because they had lower interest rates
than the current 30-year interest rate, fixed rate loan at that particular time.
Right. Some of the what we would call non-conforming or portfolio products in the early 2000s also included negative amortization loans.
And that was your option ARM for any of those that remember that.
So that was a loan where the borrower could actually pay less than the principal due for a short period of time. They usually had very low interest rates, but then they would skyrocket. So it was a gyrating loan product that, was very popular on the East and West Coast in the very high price housing markets. We didn't see that too much in Detroit. And we also had a lot of people that did 80-10 or 80-20 mortgages, basically buying a home with an 80% loan-to-value first mortgage and then getting a second mortgage instead of PMI.
And so basically they're buying a home with zero down on an 80% first mortgage and a 20% second mortgage.
And probably not paying any principal.
In fact, even going negative because you're making less than the minimum payment, and so their loan balance is going up, correct?
Correct. Also in the early 2000s, the government came out and said that they wanted to increase homeownership rates in all sectors. So they loosened underwriting guidelines when it came to down payment requirements, credit score requirements, and debt to income requirements.
And documentation requirements. If I remember correctly, we had the Nina loan, no income, no assets.
Right.
Oh, you cut grass and you make $400,000 a year, here's a loan for you.
Absolutely.
Yeah,
absolutely.
I remember the day. So what drove up to that housing bust?
It was a combination of things. I mean, we started to enter into a recession. I think in the 2005, 2006 range in Detroit, that's when I personally started to feel some pain. And then we saw the market drop out, of course, in 2008.
Yeah, I remember that.
Interest rates were higher, significantly higher.
And most of those homes, and we got to remember that when we started seeing these hundreds of thousands or millions of homes going into foreclosure, these basically had no equity.
Right.
At the point because they bought them with zero down and very relaxed underwriting guidelines at that time.
Correct.
So do you think that psyche of that particular bubble has passed down to the generation to their children?
Well, I don't know that it's passed down to the children so much as, I guess what the current market doesn't understand is what's driving house prices to go up, and it's keeping interest rates low. If you look at those two factors, based on the affordability index and what buyers are looking for, that kind of segues into the market. I mean, I see real estate professionals, for instance, that have been in the market for many years, 20 plus years. I see them being more anticipatory of a crash coming in the near future. The younger generation, I think, is just hanging on hope that, hey, I can't afford this or I can't compete in this market because I'm a low down first time home buyer and I can't compete with multiple bids and cash offers and things of that nature.
Okay, so let's fast forward here. What is it, 15 years now or so, and now we're kind of in a new market. We're seeing overbidding, over asking price, and the just absolutely low inventory. So give us a breakdown of where you think this current market is, and then we're going to dive into why we think there is not going to be a housing bubble.
Well, one of the things I think that's important to understand with the current real estate strategies, okay, let's call it that, is that some of this has come out of the foreclosure and the short sale market in 2008 to 2010. When we had a very high foreclosure rate and high short sale rate, the banks changed the temperature of the real estate market, okay? So instead of a buyer writing an offer on a house and getting it accepted, if the bank owned the house, you're going through a lot of corporate bureaucracy to get a purchase agreement to a vice president's desk that is going to review it and approve it. Even back then, they shifted to some online bidding situations where you would submit your bid online and you would wait a couple of days, okay? Real estate was never like that. If you wrote an offer on a house and you had a private seller, the seller would review it usually within 24 hours and respond. The bank crisis, the foreclosure crisis back then, changed the whole dynamic. Now, being forward to 2021, the realtors have taken some of those principles and put them in today's situation. So one of the things that is very common in this market is that an offer is presented on a house and the listing agent sits on it for 2 or 3 days to allow more people to see the house and multiple bids and offers to come in.
Trying to drive the price up.
Right. It's like the eBay effect. You know, everybody is so used to buying something online, bidding on it nowadays. They go, oh, okay, well, wait, how many other people are looking at this house? Where years ago, if you were the first one to look at the house and write the offer and you wrote a fair offer, you probably got it. You know? So the whole demographic has shifted. My daughter bought a house in Oakland County earlier this year, and she would go out every weekend and look at 5 or 6 houses. She would write 2 offers at the same time on different houses. And I said to her, well, that's crazy. I said, why would you do that?
Is that ethical?
Yeah. I said, why would you do that? And she had a great agent, but this is what was going on in Oakland County. I said, well, what if they both get accepted? She goes, well, the chances are slim. And if they both get accepted, then we quickly pick which one we liked best. We have a first choice and a second choice.
And back out of the other one for home inspection.
No, you don't even get that far. They just rescind the offer. So the sellers knew that they were hoping to get 3, 4, 5, maybe more offers, and it might be that third person that bid that really gets the house because the first other 2 might have gotten accepted on another offer, and you kind of go, this is crazy. I couldn't believe the amount of work that would go into that of writing offers in that regard. We didn't see that in Livingston County,
Right.
thank goodness.
Yeah. So let's talk about, another reason why I don't personally see a crash coming is we've had so many buyers out there putting in 10, 15, looking at 20 houses, and we're working pre-approvals for all these people, right? And we're they keep getting shot down, and they basically throw in the towel and say, look, I'm going to wait for a market shift. But in fact, what we're going to have is they're sitting out there, they've thrown in the towel, and now it's September. Kids have went back to school, and this is the natural time of the year where the market does slow down. But as soon as they see any type of inventory shift where there is a little bit more out there, or prices are just dropping a little bit because of the natural timing of the market this time of year, they're going to jump back right back in, and it's going to drive that right back up again.
Yeah, I think the Detroit market probably will be a fairly decent winter cycle if the inventory comes on the market, because you're right. All those buyers signed leases again for another year, and they said, we're going to take 6 to 9 months off, and then we'll start looking again, knowing that there might be less competition in the winter months to buy than there is in the spring and summer, depending on inventory.
Well, and inventory also goes to, why are prices dropping just a little bit? Why is there no inventory? Because we have to talk about that home seller that says, sure, I would love to sell, but what am I going to buy? So I got to hold off right now because there's nothing out there for me to buy. So it's kind of a catch-22 situation.
It is. But we see more sellers look at other ways to finance their next home, so that they can buy before they sell in many cases. So it's very common to see homes go on the market and they're vacant, right? How many times do we see homes where you go, oh, that's a beautiful home on the market, and it's vacant already because the seller has moved on because they didn't want to deal with the stress of trying to sell a house and buy all at the same time.
Absolutely. So let's go back a little bit about, I also get the phone calls regarding, and we get a lot of inquiries about all these, still about 1.6 million homeowners across the country are still in forbearance, and everybody's calling these zombie listings. Oh my God, we're going to have a slew of these listings, and if all these foreclosures come on the market's going to crash and values are going to dive. What do you think on that?
Well, I think the government certainly learned, based on what happened in 2008, that they stepped in, and they did this last April with the CARES Act. They came in and put a foreclosure moratorium on, and they immediately gave guidance to all mortgage agencies, which are ultimately backed by the government. Fannie Mae, Freddie Mac, FHA, VA, Rural Development. Okay, those are the main 5. And they said, here's what we're going to do. We're not going to foreclose upon anybody. We're going to give them a minimum of 90 days forbearance, and let's keep people in their homes. So first of all, when the forbearance situation started last April, what did we get up to? 5.7 million homeowners?
Yes.
Okay. By last June, it peaked at 5.7 million homeowners. Now, a lot of those homeowners really didn't need
Actually,
any help.
a high percentage of them didn't need the help.
Correct. So most of the people that jumped on this forbearance bandwagon didn't understand what it was. They thought somebody was handing out free money. And when they realized, no, we're just pausing your payment, you got to get it all caught up in the 4th month, they immediately started paying their house payments again. Now, certainly, the intent of the program for someone that was having financial distress was extremely valuable. But that when you look at those high numbers from last June, the majority of those people did not have financial distress and quickly got caught up on their payments. So now...
And this was due to because a lack of understanding of how the program, what was the intent and how it works.
And some people panicked. They were like, oh my God, we're going into shutdown. What is COVID? We're pandemic. Are we all going to lose our jobs and the world's going to spiral, kind of a thing. So now we're down to 1.6 million homeowners. Now, certainly, this is probably a better reflection of people that have lost their jobs, have been displaced, or maybe they have to move to a different state for a better job, and they're in a market where their house might not sell as quickly.
Okay, let's talk about them 1.6 million. Let's break that down. Out of those 1.6 million people, I'm assuming a lot of them, before they let their home go to foreclosure, because prices have been going up, there's a lot of equity.
Correct.
Please speak on that.
Yeah, I mean, nationally right now, we have more home equity than we have ever had in the history of America, meaning home prices have risen so that if someone is truly in distress and cannot afford their house payment, they should be able to contact a realtor, get a market analysis, and figure out what they need to sell the house. Because even a house that is not in beautiful, updated condition should be able to sell in this market if priced right.
Absolutely. Okay, so let's just say that takes a high percentage of these 1.6 million out of the equation. They're going to sell, bring some on to the market, which is actually needed. So now that leaves the other 50% or whatever percentage it may be. So what's going to happen? What type of sellers are you seeing here from that particular forbearance market? With they have lower equity, what are they going to do?
Well, if someone bought their house in the last 2 or 3 years with low down payment, they may not have a ton of equity to be able to sell, recapture the cost of selling a home, and pay off their loan.
And not only pay off their loan, but make up any difference from the forbearance.
Correct. So the big thing with the forbearance is that when you took the forbearance, you postponed house payments, tax payments, and any insurance bills that would have been paid by the mortgage company. So that's all going to be added to your payoff when you sell your house.
So those are some of the ones that may end up hitting the market as new inventory. But I think there's going to be another step between that before they start the foreclosure process. They are probably or most likely going to offer some type of loan modification.
Correct. So what a loan modification is, and we did see this early in the 2000s, is the bank can go to the homeowner and say, okay, you're this far behind on payments. How are we going to get you caught up? If you cannot afford to write a check and get all those payments caught up, then what they will do is modify the loan, add the missing payments to the back end of the loan a certain way, and then allow that homeowner to get back on track and start making payments again. Back in the early 2000s, one of the things that lenders did, they would modify interest rates, and they took loans to a 40-year term in order to make that payment as low as possible. So the banks are going to try to avoid foreclosure as much as possible if the intent is the homeowner is to stay in the house.
Yeah, and we got to make that, our listeners understand that. Banks aren't there, mortgages aren't designed to put you in foreclosure. Banks are there to help you. And so there's a lot of means where someone can get help. But ultimately, some of those, or a small percentage, will end up, on the foreclosure or short sale market.
Right. Now, the thing that I would recommend any homeowner that is in distress or is in forbearance and is on the verge of getting out of it, call your servicing department. It's going to take time. It might take multiple phone calls. Call as soon as you call now. The forbearance ruling for the CARES Act expires on September 30th. So in about 2021. So in about 2 weeks, this is the final window for any homeowners to apply for forbearance. When they're in forbearance, typically it's a 90-day cycle, but we have seen people that have been in forbearance now for a year. So contact your mortgage servicing company, make the arrangements that you need to make to keep your house if that is your intent. Don't bury your head in the sand and necessarily wait for them to call you. Now, some of the articles that I've read nationwide is that the mortgage companies are being proactive here and they're reaching out to these clients that are in forbearance to make final arrangements to get them out of forbearance, to move to loan modification, or things of that nature. But you need to call and discuss it, and you need to have patience. I mean, here's what we learned back in 2008. Mortgage companies do not have massive foreclosure departments. They do not have massive forbearance departments. In fact, when all of this came about last April, nobody was prepared for this. So they had to shift and train staff to get them on the phones. Now, frankly, in the middle of a pandemic when everybody got sent home. So just like everybody else in the nation, mortgage companies, servicing departments are typically short-staffed right now. And you might be talking to somebody that doesn't, unfortunately, have a lot of mortgage experience, but they're going to have to help you get through whatever process has to happen.
There you go. So the best advice there is start early. If you see a storm coming, prepare.
Yes.
You know.
So one of the things that I think is important to talk about as to where the market is shifting. So I went to a mortgage conference about 4 years ago and heard Barry Habib speak. Mm-hmm. Now, Barry Habib is, a friend of ours through the business channels that we follow daily, watching the real estate and the bond markets, so that we are up to date as mortgage professionals. But Barry said at this conference 4 years ago that we could have predicted the recession in 2008 if we would have looked at the birth rate in this country 25 years earlier and looked forward to say, when are these babies being born in the 1970s into the 1980s? When are they going to become adults? Now, the one thing that in our lifetime is important to understand is that the baby boomers are such a massive generation. Okay, baby boomers were born between, I think, 1945 and 1963.
I'm the last baby boomer.
You are the very tail end of the baby boomers. Baby boomer generation was bigger than any generation that America had ever seen. So as the baby boomers were coming of age in the 60s and the 70s, the economy was very strong. What no one paid attention to is there was a massive drop in the birth rate in this country in the 1970s into the mid-1980s.
That's the Roe versus Wade.
Yeah, I mean, not to get the political thing,
Yeah.
but there was a huge cultural change where families weren't having 4, 5, 6 children anymore. Families were having 2 or 3 children. I mean, even having 4 children is considered a large family nowadays.
So less population equals less need for inventory,
Right.
thus leads to...
So by 2008, if our economy is based on supply and demand, okay, we had no demand in the early 2000s. There were not enough adults starting households, coming into, the world of buying homes and vehicles and televisions and car seats and, whatever else they needed to buy, that Barry said you could have predicted the recession if you would have looked at that information. Now, what Barry told us 4 years ago was that now we were watching this millennial generation, and we're going to watch. 4 years ago, he said, the average age of the first-time homebuyer was 31 to 33 years old, and we are entering a 9-year cycle.
Okay, now let's move forward here till 2021, 4 years later, and let's discuss the millennials and why this is another reason why we don't feel there will be a market drop.
Right.
Okay?
We will have more young adults between the ages of 31 and 33 year after year after year. He showed a chart, and it looked like stair steps.
Yeah. And that was, I think those numbers were about 5.2 to 5.4 million a year.
Correct.
So in that age group, we're looking at about 24 million millennials
Right.
coming into the home buying market where there is no inventory.
So we still have 5 years of demand where these millennials want to become homeowners. And some of them already are homeowners. Just because the average age is 31 to 33, I have two millennial young adult children in their mid-20s that both are homeowners. So my oldest daughter is on her second home, and
how old is she?
She's 29.
Mm-hmm.
My second daughter is 26. She bought her first house 3 years ago and is already talking about selling and buying again because
A chip off the old block.
Yes, yeah. Monopoly has always been my favorite board game.
Well, and that's kind of funny. So we have the millennials coming in that are going to eat up the inventory. And now let's talk about the baby boomers, the boomers with the money in this low interest rate environment. What happens there?
Well, baby boomers are not selling their homes.
And what are they doing with their money?
Well, it's in the bank. It's in their real estate. Some of them are buying second homes.
Taking more off the
market.
inventory.
Yes. So I have a neighbor who is a World War II veteran, which would put him in his early 90s. He has lived in his home since the early 70s. And if you saw this man, Vic, you would think he was not more than 65 years old. I want to be like him.
I did meet him when we went to your house at the lake.
No,
there.
no.
That's
my other neighbor. That's my other neighbor. No. The neighbor that I'm speaking about that was a World War II vet is he walks every morning. I see him every day walking. It doesn't matter. Like I saw him this morning, I saw him yesterday, and I'll see him in January. You wouldn't think he was more than 65 years old. He's in great physical health, and I look at that man and go, he is not going to sell that house until the good Lord calls him home.
Wow.
And he still wears a cool bomber jacket, like probably from the 40s. It's really cool. But you go, you know what? Some of these baby boomers are very healthy and they're living long lives. And guess what? They don't want to leave their home. Why would they? It's paid for.
Yeah. And what I'm seeing also is, they look at, long-term investments like bonds. Bonds aren't paying anything. Savings accounts aren't paying anything. So they jump right on the old-fashioned real estate wagon because over the last 30 years, we average about a 4 to 5% appreciation, regardless if we had a 10% decline in 08 or 09 or whatever
right. And
it
if
may
you're
be.
only paying taxes and insurance, you're not going to live anywhere cheaper.
And that house payment never changes, but boy, that rent goes up every month.
Absolutely.
Yeah, that's very, very interesting. So let's talk about builder demand, and spec money from banks, from builders. So latest stats I got is we're about 4 million homes short for inventory across the country, and builders are building about 1 million homes here. What are your comments on that?
Well, let's talk about what a spec home is. Okay. A spec home is a home that a builder starts building without having a buyer waiting for it. So the builder takes the risk, digs up a piece of land, puts on a foundation, and starts building, and then at some point puts the house on the market and says, hey, pick your colors. Come in and pick your counters, tops, and your carpet. If we look back all the way to 08, the situation that happened by 2009 when the market crashed, the banks closed the doors to any builder lending.
And just let me cut in there, but back in 08 or prior to 08, there was spec loan money. The banks were handing out money to builders.
Yeah, they would say, hey, you're a great builder. You've been building homes for 25 years. Here's a line of credit for a couple $1 million.
Go build some homes.
Let's go build some homes. Let's dig up some dirt. Let's put roads in. Let's build infrastructure and create a neighborhood that you can build in. It was very, very plentiful. So when the market crashed, the banks looked at that, and it didn't matter. I saw this with many local builders. You could have been a local builder with 25, 30 years experience that never defaulted on a loan, and the banks just said, you know what? You're not building enough homes and you're not making any money. We're taking the land. They foreclosed on developments. They foreclosed on incomplete condo complexes. They foreclosed on subdivisions that were not completed.
So this wiped out a lot of the, let's say, small to medium builders.
Correct. It decimated the builder trade, especially the small to medium ones, and it then completely shut down any commercial lending that a builder was going to need. And that, in most cases, from what I have heard from local builders, it's not come back. Right. Occasionally you will see the bigger builders start some spec homes in a neighborhood, not like they used to be.
But they're doing it basically kind of on their own credit lines or their own
They
funds.
have to be big enough for that.
I work with a few builders, and every one of them is all builder funded. And they don't require construction loans. They require a pre-approval and a commitment for an end loan there. But I'm getting calls by other builders. Hey, do you have spec money? Do you have spec money? The lenders have not, the banks have not loosened up those purse strings.
Right. I mean, years ago we used to.
Yeah.
15, 20 years ago, we could have written individual spec loans for a builder. So a smaller builder could have come to us and said, hey, I want to build this house for $300,000. We would give him a loan, keep the loan on it, let him finish it, get it sold, and then, he could make money on selling a house. there's very few builders that are doing spec homes. Many builders, the smaller ones, will require a home buyer to get a construction loan and take all the financial risk
Off the builder.
Yeah.
Well,
And some buyers are not able to do that if they have a house to sell because they don't want to
qualify.
They're not going to qualify with 2 mortgages, and they don't want to sell their house and move to an apartment while somebody builds them a house.
If they can even find an apartment to rent.
Correct.
At this point. Because I know a lot of builders I work with, just 2 years ago, they would take a $500,000 upgraded home and it would take them 6 months to build. Now, at some point, just a few months ago, they were up to a year to build. And now we're starting to see that come back down to about 10 months to build. But they're still having a hell of a time trying to find contractors, material costs and all that. What are your thoughts on that?
Well, again, that points back to 2008. Do you remember all the trades that left the state?
Yeah.
When my stepfather told me in the late 1980s, because he was in manufacturing sales in Detroit his whole life, and he told me that Detroit will feel a recession coming up to 3 years before it hits. Now, our markets are different. Thankfully, Detroit's a little bit more diversified. We are obviously heavily automotive, but we're not only automotive anymore, which is 30, 40 years ago, pretty much Detroit was, hey, we were the automotive capital. We kind of still are, but we're more diversified now. And the trades left. They left. I mean, I knew electricians that had to go, union electricians that had to go sign the book in all different states. Mm-hmm. To get work. They would travel to many states just to keep working and send their paychecks home to their families to keep their bills paid. But some of those trades didn't come back. You know what? If they went to Kentucky and they have better weather there. I mean, think about Michigan. Beautiful, beautiful state. We don't have the best weather a few months out of the year. And people go, look, I can work out of state and be in a better climate to work in. My uncle has worked road construction his entire life in the Chicago area. And yet many years ago, he went to Florida for the winters because he was off in the winters. He ended up moving to Florida, lives in Florida, and has an apartment in Chicago. Now, he goes back to Chicago to work because it's lucrative for him there with his experience, but he lives in 2 different states, one to work and one to live.
Wow, and very interesting. Let's move on to, quality of life. These people on the fence, looking at all these thoughts that they have that, I think the market's going to shift because, I don't know what's going on. They hear things from the news, the media. It could be the political environment, what's going on in Afghanistan, what's going on with the pandemic and all that. And this drives to their psychology of buying that maybe I'm going to wait. What would be, I guess, your closing words and advice to these homeowners somewhat on the fence?
I think the biggest thing to keep in mind right now is the low interest rates make this a very affordable market. I had a client call me the other day for a second opinion on a pre-approval, and he was pre-approved, he thought, up to $225,000 coming into the Livingston County area from a different part of the state. He had just sold his other home. And he wanted to get his pre-approval up a little bit because he knew he wasn't going to find what he needed for his family. Well, when I talked to him yesterday, in fact, he could afford easily $300,000 to $325,000. Now, they're very conservative, so they have a certain payment range. But I had to have that conversation with him to say, look, you're not even close to maxing out what you could qualify for. Now, I am not telling you to go to your maximum qualification, but you need to find that realistic number. Sometimes buyers get a preconceived notion and say, I don't want to spend more than $225,000. And then they can't find what they want, and they get tired of looking. But and I asked this buyer, I said, what was the interest rate on your first house? He said, it was between 4% and 5%. And I said, okay. I said, we are talking right now, today, about interest rates in the low 3% range to the high 2% range. I said, you have got to look at what your family needs, find it, and then call me and let's review numbers again. Because the house that your family needs is out there. You're just looking at the wrong thing. You think you want to be in a certain payment range. You have a preconceived notion of what that price point is, and you don't understand the area that you're buying, what the taxes are, how that quantifies based on your down payment and loan strategy. So I think people need to be realistic. And if you are in a secure job situation and you know you're going to be in this area for a few years, there's never been a better time to buy. Now, if you have uncertainty in your job or you don't think you're going to stay in this area for very long, then maybe that would be a reason not to buy right now.
And if your income is secure and you do want to buy a home, I tell a lot of clients like this: if you're concerned about a market shift or values dropping, regardless, you need a roof over your head,
right?
Whether you're going to rent or buy. So if they were to buy a home, they're buying that for a long-term investment. And I can guarantee values are going to go up, they're going to go down. But over the long haul, it's going to be a win. And when values are dropping, when that's a concern, is go ahead and buy your home, create your mothership, create a quality of life for you and your family. And then as values drop, maybe invest in real estate for a second or an investment home. That's how you buy real estate.
Yep, that's a great strategy.
You don't, if you're going to sell high, you're going to go buy, and you're going to buy high too.
Right.
But if values go down, you don't want to sell. Have your mothership all set up, and then if you want to create wealth, save that money. And if you have an opportunity, when and if values drop, land another property as a rental or something, or for your children or something like that. But you still have to have that mothership to have that quality of life.
I mean, if you're paying rent, I had somebody that we closed recently that had paid rent for 10 years. And we did the math on what they've paid in a 10-year period, and it was $90-some thousand. And they were very nervous about buying a little condo. And I went, guys, you're spending the money anyways. Renting is not a bad thing if you're not going to stay in the area, or you're just getting started, or it's not time for you to put down roots. Right. It's okay to rent. We're not saying it's completely bad to rent, but as a long-term strategy, that's kind of scary.
It's funny because people come and say, why do you want to buy a home? I'm sick of throwing out money. Okay, let's go buy. I don't want to buy right now. Prices are too high. There's going to be a crash. And I said, okay, then there's the cost of waiting. So we take that house that they're going to buy, look at the appreciation rate over the last 10 years, and we say, look, it's going to go up $600-800 a month. You're throwing away money there.
Right. Well, inflation is the enemy to interest rates.
Right.
Okay. That is an absolute truth. That you can look back 50 to 75 years in this country and know that we're under inflationary pressure right now. There is a chance that we will see a recession in the next 12 to 24 months, which, as recessions don't have to be terrible. They're cyclical in our economic cycle, but inflation is going to cause rates to go up. The government is already talking about tapering the bond purchases that they're making, which started because of the CARES Act. It could start before the end of the year. It definitely will start by March of next year. And that's the wild card, right? If interest rates go from 3% to 4%,
yep.
Even 4% is still a great rate. 4.5% is still a great rate. Anything under 5% is amazing, in my opinion. But that's what the buyers can't quantify. That even if a house price went down $10,000, but if the interest rate goes up 1%, they're still spending more money than they would have if they would have bought sooner.
Yeah. And you look at, if you're renting, inflation is your enemy, because as inflation goes up, rental prices go up up there as well. But if you are a home owner, inflation is your friend, because your principal and interest never changes, but inflation drives values up for long term.
Right.
So any closing words here?
Well, I think whether you're ready to buy a house or sell a house, it's an individual process. So you have got to, get educated, talk to your professional real estate agents and loan officers, and come up with a plan that works for you. No one should be making the decision for you, but you need to be educated on the options so that you can make a decision. I think the lack of education in the market is what's driving people to not be able to make decisions.
And that's why we are here to help. That was Danielle Boote, loan officer extraordinaire. My name is Victor Bals for A Smarter Way Home, and we'll see you next time. And remember, we all got to try to get along.